This will be a brief review of a certain type of dividends, that being cash dividends. It's usually the most common type of dividend, and it is a distribution of corporate earnings. So there are different types of dividends. There are cash dividends, there can be stock dividends or property dividends, and there's even the concept of liquidating dividends. This is going to look at cash dividends. Preferred stock usually has a fixed amount and it's expressed as a percentage. Common stock dividends will vary. In order to distribute dividends, there have to be accumulated earnings available for distribution. And retained earnings can have restrictions, so to be able to declare and pay dividends, this comes from unrestricted retained earnings. You can almost compare it to the concept of an owner's draw. For sole proprietorships, you have the capital account, the owner's withdrawal account. With partnerships, you have numerous partner withdrawal accounts. With corporations, it's not quite the same thing because the owner can't just take out money whenever they want. It has to be declared by the board of directors, but it is a distribution of income to the owners. That's what a dividend is. If the dividends exceed retained earnings and you're getting into a debit balance of retained earnings, that is known as a liquidating dividend. So first, what's the difference? Interest versus dividends. Well, interest, that's a legal obligation. Interest has to do with notes and bonds, which comes in a later chapter. When we're talking about dividends, we're talking about stock. Now, interest, that represents an expense. Dividends paid out is not an expense, it's a return of capital. There is no legal obligation that exists to distribute dividends other than after they are declared. It does represent a return of capital. And it's important to know the dates. There is the date of declaration. When the board of directors declares the dividends, you record a liability and decrease retained earnings. So for a cash dividend, it would be dividends payable. Then there's the date of record, which will come later. There is no journal entry required. And this is when you're just determining who owns the stock, who gets a share of the dividends. And the date difference, after a date of declaration, this actually is sometimes a way to encourage others to invest in your stock, because the time between the declaration until the date of record, you can invest in that corporation after the declaration and still get the dividend as long as it's before the date of record. Then finally, the date of payment. This is where you have another journal entry. You remove the liability and record the cash going out. Important terminology, there is a difference. There's a common dividend payable. That has to do with a cash dividend or even a property dividend. It is a liability once it's declared. A stock dividend is different. The stock dividend never actually leaves. It's just a redistribution of equity. And that is a common dividend distributable. So a common dividend payable is a liability. Common dividend distributable of a stock dividend is another component of equity. You must have adequate balances of accumulated retained earnings in order to declare a dividend, or you should. And adequate cash must be available to pay a cash dividend. There are other types of dividend that may eventually be distributed in place of cash. You can have a property dividend. Let's say you want to keep your stockholders happy, but you just don't have the cash, or you're holding on to the cash for a future project, so you declare other types of dividends, property dividends, or even a stock dividend, which will be covered in a separate video. So looking at an example, on February 28th, the board of Surge Corporation declared a $375,000 dividend. On the date of record, there were 500,000 common shares outstanding. Outstanding are the only shares that can participate in the dividend distribution. Because remember, you have authorized, issued, and outstanding. The date of record scheduled for March 15th, date of payment April 1st. So February 28th, the date of declaration is when you record your liability journal entry. But between the 28th and March 15th, anyone can invest in this corporation and take part in the dividend distribution. And then finally, April 1st, it's payment when the dividend payable is removed and the cash is paid to the shareholders. Now, you could hear this talked about in different ways. Some corporations might say the board declared a certain dollar amount, that 375 dividend, and then how much each shareholder gets is going to depend. It's going to depend on how many shares are outstanding at the date of record. The more shares, the more it's spread out, the less you get per share. Some corporations may declare it differently. They could declare a 75-cent per share dividend. And then on the date of record, they look at how many shares are outstanding, and that is what is going to be recorded. But no matter what type of dividend, it comes out of retained earnings. And retained earnings is that equity account. Instead of a capital account where you track everything, you have separate accounts for a corporation. And net income is accumulated earnings. Retained earnings is a permanent account. Dividends, you could sort of compare it to an owner draw, only it must be declared. That's going to decrease your retained earnings. It doesn't matter what type of dividend, it all comes out of retained earnings.